Hello, today we were discussing Hasbro, ticker HAS. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. Market cap is $8.3 billion, enterprise value is $11.6 billion, so you can see about $3 billion in net debt on this business, which is quite significant because that's a little about 30% of the overall enterprise value. Leisure products industry, they operate and play entertainment company in the US and internationally. They have consumer products, Wizards of the Coast, digital gaming, and entertainment segments. Consumer products has sourcing, marketing, and sale of toy and game products. So that's a key point here. Toy and games has brands through out-licensing, trademarks, characters, and other brand IP rights. Toys include action figures, arts and crafts, create and play, etc., etc., etc. The Wizards of the Coast and digital gaming segment includes promotion of its brand through the development of trading card, role-playing, digital game experience based on Hazards and Wizards of the Coast games. Of course, Wizards of the Coast would be Magic the Gathering is their primary gaming segment there. An entertainment segment includes development and acquisition, production, distribution of entertainment. So this is probably, working on your IP of their other games, including television, family program, and digital entertainment. So I usually really think this is a really interesting industry, the entertainment industry. You can get some very strong returns on invested capital because of how this business works. You're really capitalizing on IP, on brands. The use of brands and IP really allow you to get that extra margin on your sale price. Now, beta of 0.71 here is a good sign for it to be a relatively high quality company. The lower it is below 1, that means the less volatile the stock is. And normally the less volatile the stock, the more high quality the business tends to be. Not always, but that is one thing that I look for. Now, as we go to the return on invested capital chart, we immediately see something very good. We see 20 straight years of profitability. That's always a very positive sign for a business like this, that you can have 20 straight years of profits. That's a first sign of a high quality business. Now, one thing that I don't like is when we look at 2016, it looks like your return on invested capital peaked at 15%, and it's been trending down since then. So the business looks like it's been deteriorating over that time period. Now, I do believe they've made acquisitions during this time period, which could play a role in this return on invested capital. We could see an increase in intangible assets, and so we're going to have to do a dive into that when we get to the income statement and balance sheet to really make sure we understand what's going on there. But overall, I don't like this deterioration in the return on invested capital. You can see they went from solidly earning double digits above this 10% line for most of their history here to now been below it for the last 5 years, 6%, 9%, 2%, 5%, and 2%. These numbers are a little low for me to be super interested. However, this could be due to intangibles, so I have to keep my mind open to this being a relatively good business. You see these 10-year median returns, we immediately see some numbers that catch my eye as attractive. Return on equity of 19.5%, return on invested capital of 9.5%. Now, I would really like this to be a 10% number, but I'm not going to have qualms over 9.5% or 10% because my return on equity target is 15% plus, and this hits it easily. When you hit a return of 19% like this, you can relatively easily self-fund all your growth. You're not going to be needing to take on debt. You're not going to be needing to dilute shareholders in order to grow. And so that's a very good sign because it means the business should be able to grow without that dilution component. So everything here is saying, hey, this is a high quality business. I have a little bit of concerns about the last 5 years, but overall that could be a reason for opportunities in the stock. However, we see that the PE is 69. So the first thing I'm going to think is like, okay, so your close price here is 60, and I want to check to see if they have a history of earning more than, say, $1 per share. And it looks like they do, so, well, at least on dividend. So here you go. You can see that they have a history here of earning $4 in 2019, $3 in 2021, down to $1.46 in 2022. And I'm wondering if the trailing numbers are even worse than $1.46, because if you just take $1.46 and you multiply by 69, you can see that they get above 60. So something on this valuation ratio is not accurate. So for now, we're going to ignore that, because if we just say, okay, well, what is the PE if we look at 2019 earnings? And 2019 earnings were $4 a share, and that would be a PE of 15. All of a sudden, we have a reasonable price. PE of 15 is a very reasonable price, but they haven't hit that number in the last 3 years, so we want to understand what's going on with that business. It's especially surprising because in 2019 you had revenue of $4.7 billion. Your revenue is substantially higher now, but we're showing worse earnings despite having better gross margins. So what is going on? Because something here doesn't make sense. Do we have some one-time write-offs? Because the profitability still looks good. One reason you can see that is that the dividends are still being paid out at a pretty high level, $2.78. This doesn't make sense if you're consistently earning more than that over the long term. You'd have to cut your dividend, you'd have to pause your dividend, do something along those lines, because you can't keep raising your dividend if your earnings power is actually reduced. So I'm going to guess right off that the earnings power is understated based upon these numbers. You can see that what they're showing is a decline in EPS for the last 10 years. That's not good. You had $2 EPS at the beginning of the decade, $1.46 at the end of the decade. That's not a number that I like to see. But again, I believe this number is probably understating. And so if we're going to look at our growth rates, I'm going to use something like this revenue growth rate of 3.7%. And we're going to just keep that in our mind that maybe 3 to 4% is what our growth rate is right now. So no qualms yet on the valuation because I think something's up with that, but overall the business looks like a high quality business. We're going to go to the income statement next, but before we do, hit that like button. Don't forget to become a subscriber. We're covering every company in the S&P 500. So let's look at our cost of goods sold. You can see this is some of that operating leverage that I like to see. So your revenue has gone up from $4 billion to $5.6 billion. So that's a $1.6 billion increase, but your cost of goods sold has only gone up from $2 billion to $2.3 billion. So your cost of goods sold had gone up by 15%, but your revenue is up by like 40%. That's going to lead to operating leverage, which is why your gross profit is up by something like 70%, 65 to 70%. That's operating leverage. Operating leverage is very important for a successful business. You really like to see that. So it is happening on the gross profit line. On the other hand, their SG&A has been growing quite quickly. You can see that their SG&A has gone from $1.2 billion to $2 billion. So you are up a significant amount of your SG&A. So that is growing quite quickly. It's actually growing faster than your revenue. So that's some reverse operating leverage. I don't like seeing that as much. There was kind of a big jump in some of these years here. So I want to understand why do they need so much more SG&A than they've had before? That's not a good sign. Now, you do see some distortions here through other non-operating income really hitting these 2020 and 2021 numbers because we said our 2019 number was our peak. But then over the next 2 years in 2020 and 2021, you actually beat that number. So what's going on here? Why is it that your operating profit is up, but your pre-tax income is down? It's because you have these other write-offs here. You do have net interest income going up, a lot of extra interest. So I wonder if, again, acquisition could play a big role here. In this as well. You also see a little bit of dilution. So I'm assuming, again, acquisition 2019, 2020 played a role in that. You don't really see any sign of, consistent buybacks. You started at 132 million shares outstanding. You ended 139 million shares outstanding. So less than 10% of total dilution. I'd say it's less than a 1% impact, kind of immaterial to my analysis. Let's go to our balance sheet. One of my concerns was an increase in intangibles, and we do see that here. Again, it's clearly showing where our acquisition took place because from 2019 to 2020, you see a jump from $495 million to $3.6 billion in goodwill. Same here on the other intangibles line. So that took your assets up very significantly. You went from $5 billion in assets to $10 billion in assets, and when you combine that with some short-term write-offs, that can equate a lot of what we're seeing here. 2019 was, of course, a good number. We've already looked at the operating numbers in 2020 and 2021 were even better than 2019. So all of my concerns here for maybe deteriorating assets is gone. I'm very pleased with what I've seen in that this is probably going to turn around. They did end up having to pay up for this, but we do see that on the operating line basis, it looks like they've been improving. They've been getting better. So I have a little bit less concern. They did have to take on debt for that acquisition, but they've already started paying it down from $4.6 billion to $3.7 billion. So it looks like our interest expense should go down a little bit over time. So that shouldn't be as much of a concern either. Let's go to the cash flow statement. One last thing on the balance sheet. You can see that property and plant and equipment, $230 million, $423 million at the end. They're earning basically 100% returns on or more on their PP&E. They don't require a lot of property, plant, and equipment. It's really a lot of intangible assets here. And of course, when we get to our cash flow statement, you can see the big cash flow outlay for this acquisition, 2020 hitting there $4.4 billion. They had to take on a bunch of debt in 2019 to complete that. They took on more debt in 2020 to complete that. And that all plays into that as well. Despite those things, you see that they had 10 straight years of positive cash flow from operations. Always a good sign on that end. And you can see that the depreciation and amortization has gone up significantly, which is another reason for their net income number being down. These numbers will trend down a little bit over time once that, has really played out. This is a lot being driven by these acquisitions. So you can see that playing in there. You can see they've already started making those, paying down their debt, and they're continuing to maintain their dividend because they're still cash flowing very, very strongly. Not very concerned on this piece. Overall, the numbers here look really good. What's actually nice about Hasbro from a potential investment perspective is that their numbers look worse than the underlying business probably is. We see a deterioration in the EPS number, but they've maintained dividends per share because the business continues to clearly operate well. You're continuing to have growing revenue. You did have a down year in 2022. There's a lot of reasons for that. Maybe that could be, it would require a little bit of investigation. You don't want to necessarily be starting to buy when this business is maybe deteriorating in the future, but the bones of this business are very good. You can see they're earning very strong returns on equity, very strong returns on invested capital. A lot of this recent decline is due to the increase in intangible assets. They basically doubled their asset base, but we've really not seen that flow through yet to the operating capability. We know when we looked at the income statement, we saw operating leverage on the gross profit line. That's a very good sign. You really like to see that. And so I'm encouraged about the potential of this business. And I would say that Hasbro probably will go on my watch list. I really think this is an interesting industry. Entertainment gives you that possibility for good, strong returns. So again, Hasbro, going on my watch list. Hit that like button. Don't forget to subscribe. If you want to check out more videos, they're available up here. You have both my watch list companies and the best recommended video for you. If you enjoyed this content, quickfs.net is my affiliate link, is the first link in the description below. That is the software I'm using to make this video. Thank you for listening, and until next time, stop paying fees, start building wealth.